Good afternoon, everybody. This is Tim McCusker, Chief Investment Officer from NEPC. Welcome back to our second round of the CIO Conversation Series. I'm excited to have everyone aboard today and thrilled to have with us Bob Prince, Co-Chief Investment Officer of Bridgewater Associates. We're going to hear how Bob and his team have adjusted to the work from home environment and get a great rundown of Bob and Bridgewater's view of what's going on in capital markets and the global economy. So Bob, thanks for joining us today.
Great, thank you, Tim.
So Bob, the first question, a little bit more personal. How have you personally adjusted to working from home, and how has Bridgewater as an organization adjusted?
Well, I would say it's been pretty fluid. I guess it was about a year ago that we started working remotely on it, here and there. And I had started working remotely on it, once a week or something like that. And we had instituted some technology, the Zoom technology that allowed us to have that sort of interaction, and whether we were in the office or out of the office. So we had, I think, at one time, the world's largest Zoom meeting. It was the entire company. We had company-wide meetings on Zoom, 1,500 people. So we had started to use that, and I think that's one key technology. The other one is AWS and the ability to basically access your desktop computer from anywhere. And between those two things, from a technology standpoint, we were ready to go. And then I think another key thing is that, we have three different kind of roles at Bridgewater. We have we have research associates, we have technology associates, we have management associates. And the management associate role is a full-time manager. And that has been key because the managers, the people who all they do is manage, oversee, and make sure things go well, they have been fantastic. They've been calling us people every day. They take productivity surveys, morale surveys. So I think, and then every week I get a report of how it's all going in the investment engine and then in the company. And, for example, on Friday, we've got the stats we're 95% fully productive. We've got, 90% of the people are submitting their daily updates. Morale is on the upswing. It's high, all kinds of things. And we got people in 20 states and 6 countries. So and if anybody who has an issue, like we had a few people that get sick, and so they're all over that. And, my assistant and her family got sick. And so, we're sending them food and, all kinds of things like that. So to have the management team in place, a full-time management team, has really made sure everybody's taken care of, but also freed me up and others to be, really focused on the big issues and the portfolio and the markets and the research. So I'd say for me, it's been actually highly productive because of the ability to focus, just to focus. And of course, necessity is the mother of invention. So you get an economic environment like we're in now. It challenges you to come at things from another direction, and it challenges you to your agility, your adaptability, and that challenge is invigorating. You take a few deep breaths along the way, but it's really invigorating and exciting. And so it's been one of the most productive kind of 6-week periods of research for me.
That's awesome. I love the positive tone of these challenging times, finding the invigorating part of it. But Bob, I've got to ask as a follow-up before we get into your thoughts on markets. At Bridgewater, I know you're all very proud of the culture that you have, the radical transparency, being willing to give feedback, the meritocracy where it's about the best idea, not the level of the person delivering it. Does that translate in the same way remotely and using technology instead of being face-to-face with folks?
Yeah, I find that it does. And once again, I think by having a group of people who are focused on management associates, that's part of their responsibility to make sure that the culture is carried through. And so, when we've had our points of disagreement or whatever the issues are, they call time out, they pull us together, we we go through it just like we would in the office. So and I would say they're equally on top of it, if not more, because they're on the phone every day, multiple times a day with people to take their temperature, know what's going on. Dave McCormick, CEO. Dave is in our research discussions, all of our research discussions, and he's in the middle of it. And our head of research, our Niraj Bardea, who's head of research, he's in all of our indicator research discussions. And so, any kind of management issues that come up, man, they're on top of it and escalating those things. I would add that the systemization of the culture has been a big push for the last, 5-7 years, something like that. Meaning to create processes like an issue log or the DOTS process that we have, and all of those things are implemented by way of your desktop computer or your iPad, and so I can enter DOTS and see DOTS on my iPad. And because I can, through AWS, because I can connect into the office, it's literally the same thing as being in the office from that standpoint. So the technology, I think, that the systemization of the culture by way of certain processes that we follow is something that sustains that culture and enables you to execute it remotely.
Interesting. So let's get into markets. Let's hear how you guys are thinking about the world. I should have mentioned this up front, so I'll just jump in for 1 second here, folks. If you're interested in asking a question, we'd love to get some questions from clients to Bob. In your WebEx window, you've got the chat function. Feel free to type up a question and get it in there, and we'll definitely save some time for questions at the end. So Bob, let's talk about your global outlook. What do you see happening in the world right now, and how are you thinking at Bridgewater about what the forward picture is going to be?
Well, I think we probably see it differently than most. The way I would describe it is there are the three big things to register is that we've had a collapse in global income caused by a pandemic, with interest rates at zero, and particularly bond yields in all the reserve currencies. That combination of circumstances is, all three are extremely unusual, and working together, they create a lot of uncertainty about how to pull out of this. And so just to clarify what I mean by that is that when I say a collapse in income caused by a pandemic, that's not normal. Normally what happens is an economic downturn is caused by a tightening of monetary policy, typically in the late cycle when there's some kind of inflation problem brewing. The tightening of monetary policy causes a pullback in credit, which cuts spending, less income, more unemployment, and that causes that downward, I refer to as a flywheel between spending and income, back to spending, back to income. That starts to decline. But then because that was triggered by the tightening by the central bank, once you've brought that inflation pressure under control, the central bank eases monetary policy, they cut interest rates, that stimulates an expansion of credit, housing, autos, which produces spending, which produces income, which puts people back to work and reduces unemployment, and you're off to the races. That's the norm. This time, you have an instantaneous collapse in income because people just stayed home and stopped producing things. So production fell, income fell, and with lower income comes lower spending. And the counter attack by the government has been to try to fill that void in spending by fiscal stimulation and monetary production of money. So that's the attempt to keep the spending going at the old level as if you had a 3.5% unemployment rate, even though effectively the unemployment rate right now is somewhere between 15 and 20. Now, so that's the income and pandemic part. Then you've got the zero interest rate part. That's a radically different set of circumstances, and very dangerous and very risky, because a reduction in interest rates is the primary tool to pull you out of a downturn. You don't have that. So with the bond yield at 50 basis points or something, you can't cut interest rates. Now, what that means is if you can't cut interest rates, you can't use that to stimulate credit growth and then spending. And so you have to find some other way to do that stimulation. Furthermore, from the standpoint of, let's say, the equity market it has asymmetric risks, because the downside doesn't have the potential cushion of a decline in bond yields that can reverse the economy and raise cash flows and earnings. But also, if the bond yield can't fall, you don't have a lower discount rate on those cash flows, which typically would support prices. So the fact that the fact that the bond yield is zero, while you got this collapse in income in this pandemic, and the pandemic is unpredictable because its impact, it revolves around medical developments, but also how society responds to the trade-off between mortality and economic conditions. That's an imponderable question, and it's going to differ across countries. So those conditions create a massive degree of uncertainty. And I just want to reaffirm one thing related to the zero interest rates, which is that, even in the Great Depression in March of 1933, when the FDR basically closed the banks, delinked from gold, started printing money, the bond yield was 3.5%, and the short-term interest rate was zero, but the bond yield was 3.5%, and it had come down from 4.5%. Well, if you got a 3.5% bond yield, you can fund it at a zero short rate. There's a lot of spread there, and then the bond yield fell from 1933 to 1947 by almost 200 basis points to 1.8%. That was the low, 1.8. We're now at 50 basis points, 60 basis points. So we've never had literally a zero bond yield in the United States. Now, of course, you've had it in Japan, you've had it in Europe, and they've had a lot of trouble stimulating any kind of economic activity. So we now have all the developed countries in the world with a bond yield near zero, which creates those risks for the economy and equities that I'm talking about, and the difficulty of the economy pulling out of that. At the same time, to invest in bonds doesn't give you the same degree of protection that it would have, and it's the expected return is close to zero. So it presents a lot of problems for the traditional portfolio, let's say 60-40 portfolio, because the bonds now have a zero return and they don't give you much diversification, and the 60 side has the asymmetries associated with it. So that's a really unusual set of circumstances to deal with. And I'm sorry, I'm going on probably too long, but so what we really then end up with is these two big forces at work working against one another. You have the deflationary force of the collapse in incomes and the associated collapse in spending, attempted to be offset by the reflationary force of the fiscal stimulation and the printing of money. And the net balance of those will determine how the average set of circumstances plays out. But even within that average, you're going to have a very wide differentiation from one person to another, one city or state, one company, one country, and even different regions of the world, I think, are going to have a differentiated outcome, because the effects of the income on various people will differ. I like to think in terms of a duration. There's a duration mismatch, which is that most scientific explanations of the virus suggest an 18 to 24 month period of intermittent social distancing and that sort of thing. In other words, lingering effects of this on income and spending for 18 to 24 months. Well, let's call that the duration of the virus. What's the duration of the cash on the balance sheet of the typical person or company? How long can they last? And then how long can the government and the central bank repeat what they just did? What they've just done basically covered about 3 or 4 months. Let's say you've got 18 to 24 months. What happens as you go forward? And that's in the United States. What about countries that don't have the same borrowing capability or the ability to print money in dollars? So so you're going to get very wide differentiations in the outcomes that occur across companies and countries and even regions. And what I mean, and just to point out something on regions, is that an interesting thing is happening in New Zealand. In New Zealand, they've cut their cases down to 0. And what they've said is they're going to start to do business with Australia because Australia has cut their cases down. So there's going to be travel between New Zealand and Australia. Now imagine if every country says, I'll do business with countries that have similar stringent virus policies as we do. Well, will China and the rest of Asia, will they accept business travelers from Italy and Europe and the United States, or are they just going to accept travelers from inside of Asia, from Korea and so on and so forth? That could potentially reinforce the differentiation of the economies that's already underway and further create a divide between East and West. And so even to the extent of differences in regional outcomes, I think we'll be probably seeing this unfold.
Wow, a lot of different directions we could go there. Maybe coming back to I think one of the most interesting parts there was that duration mismatch that you talked about, 18 to 24 months for the virus to play out, 3 to 4 months of policy transmission at this point. There's a big difference between monetary policy and fiscal policy. At the very beginning, you talked about how effective monetary policy is in kind of classic monetary policy of lowering rates, stimulating borrowing, getting economic activity going, much less effective when rates are at 0. And then fiscal policy, probably less effective than that. Can you spend a little bit more time on the size of the fiscal policy that we've seen and why that may not be enough because not every dollar gets spent?
Yeah. Well, the $2 trillion that we got in the United States was roughly the right amount of money to offset when I say it's roughly the same amount as the reduction in income for about a 3 or 4 month period. So that calculation was done right, meaning that, let's say if somebody's on unemployment insurance, they're probably getting as much or more cash now as if they were working, at least for some period of time. Now the question then becomes, what do they do with that money? Because the fiscal policy action that's been taken has been a borrowing by the government and sending out checks to people or sending out checks to companies. But all that's done is augmented the income that's been lost. The only way the economy stays where it was is if that money then gets spent, because spending is GDP. So if all of that money, if all of the $2 trillion gets spent, then your GDP is right where you started in January. But when you look at surveys of what people are actually doing with the money, some suggest that maybe half of it will get spent. Maybe half of it will go into debt reduction or savings, which makes perfect sense. If people are worried about losing their jobs, it makes perfect sense that you'd say, hey, I'm going to take this opportunity to cut down on my debts, or I'm going to put a little extra money in the bank. And so for the individual, that actually might make a lot of sense. But for the collective, that actually prevents that stimulation from having the effects that are intended. And so imagine if everybody spent, 50 cents on the dollar, then to get $2 trillion of spending, you really need a $4 trillion fiscal program. So that's the first layer, which is that you've got the amount of money the fiscal government is sending out. They're augmenting lost income. They're not spending. I'll contrast that with, let's say, FDR and the WPA type program. That there's a different way that fiscal programs can work, which is that fiscal stimulation can work, which is that instead of the borrowing going to then send out checks to augment lost income, if the government actually spends money, if they spend money on highways or dams or bridges, or even if they spend money on military equipment like World War II. When the government is literally buying things, as they buy things, they are the spender in the economy, and they are producing the income for people who have those jobs, and they're creating jobs, and the people who have that income from those jobs, then they spend that. And so I refer to a flywheel, where you've got to get the flywheel is the interactive process between spending and income, because one person's spending is another person's income, which they then spend, which is then somebody's income, which they then spend, and you keep going round and round that flywheel. Well, if the government is spending money, then they're producing income for people, which they then spend, and that turns the flywheel in a much more efficient way. But if the government is just sending checks out, you may or may not spend it, and the government is then dependent on people doing what they think that they'll do. That's on the fiscal side. On the monetary side, it's even more indirect, because you could take it's about 5.8 trillion by the Fed. You could take the 5.8 trillion, you could divide it into two parts. There's about 2 trillion, which is essentially funding, buying the treasury bonds to fund the fiscal program. Then there's another 3.8 trillion that's effectively just going into buying assets. And by buying assets, they're trying to both hold the prices of assets up, because lower income means less buying, but have assets, which means lower prices. So they're trying to hold the prices of assets up, and in the process of doing that, create wealth effects that support spending. But that's a very inefficient process, because the Fed, prints money and they buy a treasury bond. Let's say they buy $100 a treasury bond. Well, how much of that, now the person that held the treasury bond has cash, what are they going to do with it? If they put all that money and bought stocks, wow, that'd be great for the stock market. But if they just stick it in a money market account, it's not going to do anything. So a lot of people don't put it to work. It's actually historically a very small fraction that ultimately finds its way into something like the equity market, or finds its way ultimately into spending. So for the printing of money to have that same kind of effect on spending, you have to have an even higher multiple of printing in relation to the spending that you're trying to produce. Nonetheless, what we can say is that the coordination of the fiscal policy with the monetary policy, that's the best chance of having a positive outcome, because then the printing of money is actually getting routed into the economy directly by the government, and then it's just a question of whether they route it into augmenting income or whether they route it into direct spending. The spending sounds like the better path, but it's a much harder path to implement at the federal level.
Okay, and we've got a question here that I think is pretty relevant, so I'm going to ask it here. You talked about the spending being enough for 3 to 4 months to get us through the word, and you also referenced FDR, the 1930s. A word getting thrown around here and there is depression. Do you see that in the range of outcomes? Is that not for the next 3 to 4 months because we have enough, but still in the range beyond that? How are you guys thinking about that?
Well, first, I think you have to distinguish a recession from a depression. A recession is an economic downturn triggered by the central bank, largely ended by an easing by the central bank. It's related to the expansion and contraction of credit, like I described. This is, at the outset, I think it was not clear whether this is going to be almost like a 1-month vacation and we all go back to work, or whether it's sort of a pothole, or whether, we're going into a deeper ditch. And a depression, I think, would be a self-reinforcing process that sort of takes on a life of its own, where the central bank finds itself unable to reverse that, and which then typically produces deflation and so forth. So the government and the Fed are trying, and all central banks around the world are trying very, very, very hard to avoid a depression, but it's we're not out of the woods. I would put probably a 60% chance on a depression, and what I mean by that is a self-reinforcing process where that flywheel is going in the wrong direction, and the driving force of that is in this case is likely to be companies going out of business, where as companies go out of business, jobs are permanently lost. And as jobs are permanently lost, then that income is lost, and then the associated spending is lost, which then produces a continuation of that contraction or low level of spending. It's going to be a funky, even if that plays out that way, in many respects, people won't call it that or see it that. And the reason is because most people are focused on growth. What's the growth rate going to be in the second, third, fourth quarter? Oh, we're going to have a bad second quarter, and then we're going to have a good fourth quarter. Well, growth rate is just the change in output. The issue here is not the growth rate. The issue is the level. If you go, if in the Great Depression, if you had a 25% unemployment rate, if you went from a 25% unemployment rate to a 15% unemployment rate over the course of the year, you would say, wow, we had fantastic growth. We had a 10% growth rate, but you still have a 15% unemployment rate. And so what's happening now is it's not the growth rate that's the issue going forward. It's going to be the level of income and the level of spending that's going to be the issue, because of that duration thing, which is that if the level of income remains depressed for 3, 6, 12, 18, 24 months, the lower level of income has a grinding effect on companies, countries, states, because the level of tax revenue is lower, the level of profits is lower, but the cash runs out and the debt service is still there. And even if the government is lending you money, you're piling up debts. So that it's the duration mismatch between basically how much money and you could think of it as how much money do you have in the bank, and how long does this last? Because if you don't have income and you have only a certain amount of money in the bank, and you have to spend the money in the bank to live, but if the thing lasts longer than the money in the bank, then you're bankrupt. And that's true whether you're a company, a country, or a person. So it's a race against time to keep income levels up, to have between monetary and fiscal policy, maintain a level of income and spending that's high enough that you don't cross that line and get that self-reinforcing process. So chances are, like, it's such a wide range of outcomes that we refuse to even bet on any of them. So much uncertainty. But if you could imagine it, I think the cleanest, simplest way to imagine it is that, let's say we have a 15, 20% unemployment right now. Okay, it's 15% unemployment, but we sent enough money out to effectively make it like a 5% unemployment rate. But really, it's still 15. Now, let's say we come back out of this. And we came in with a 3.5. Are we going to go 15 down to 3.5, go right back to where we were? I don't think so. I mean, so if we go in at 15, let's say we come out at 8. Well, the peak unemployment rate in the financial crisis was 10. So if we go in for 15 now, even if we cut that in half as we come out, you're at an 8% unemployment rate. At an 8% unemployment rate, you have difficulty, right? Just the grinding difficulty of a low level of income in relation to your balance sheet. And so the balance sheet starts to deteriorate. And that would be the driving force of whether we have, whether we have a quote depression type environment, or whether we kind of are able to bounce right back out of it.
And Bob, I feel like, and it could just be my own home country bias, but a lot of that was about the U.S. and our Federal Reserve. Our government has done a ton to react to this and provided a lot of stimulation that maybe not, but gives us a chance of getting through this. Can you talk, you mentioned it very briefly, the challenges that countries that don't have a reserve currency have with this. Can you talk about other countries and how they might navigate this, given the extra challenges?
Yeah, well, you can kind of line them up. So you have your countries that typically have balance of payments vulnerabilities anyway, debtor countries that are reliant on foreign capital that have particularly high U.S. dollar denominated debts. So that's like your Brazil, South Africa, Turkey, Mexico to some extent. Those are your your debtor deficit weak currency countries. On the other side, you've got your Asian economies that tend to have very high savings balances, high foreign exchange reserves, fiscal balance, interest rates are not zero, and big current account surpluses. And so if you're a saver with a lot of money in the bank, you're going to be less affected than if you're a debtor with a lot of dollar-denominated debts. And so, you can kind of line the countries up along those lines and see those impacts. Then when you go to something like Europe, you have the natural difficulties of a single currency without a central government. And how do you coordinate programs to get money where it needs to go, and how do you get everybody to agree on that? So you're going to have, they are doing things, but it's a cumbersome process. And, so your Italys and your Spains are going to be more vulnerable than your Germanys and your Netherlands. So it's the same dynamics as an individual, saving is savers versus borrowers. And, what is the strength of your balance sheet? Another duration concept I think is an interesting one to think about is that think about the oil market versus, let's say, a tech stock like a Microsoft. They have radically different durations. The oil market is a very short duration asset because it can only be stored above ground for a limited number of days. And so what we saw last month was we saw the collapse in income and the collapse in the demand for oil meant that there was just no need for the oil, and yet it's still coming out of the ground, and there's no place to store it, and you can only store it for a certain number of days. And so literally, maybe the expectations for oil in the future was $20 or $30 a barrel, but literally at delivery date, there's more oil than people want, and so the price goes zero or goes negative. And that's a cash flow effect, which is different than an expectations effect. The cash flow effect will manifest in a way that's undeniable unless you get cash flow. So that's a short duration asset. Whereas, let's say if I take Microsoft or some tech company, let's say that's going to be around for a long time, it's unlikely to get out competed. Well, if that company has a couple of bad years for earnings, but if it's a very long duration asset, the present value of 20 years of cash flows or something like that is really not even that much affected by one or two bad years. So therefore, that lower level of income has a much less effect on a long duration asset than it has on a short duration asset. And the same thing will play out in a strong balance sheet versus a weak balance sheet of individual companies and countries.
And so you guys have written a lot about China. That's been an area of focus. Should we be thinking about China as a long duration asset? How do you expect China to withstand everything coming through this? And then you've written a lot about the tension that exists as China emerges as a global player. Does that get accelerated through all of this?
Well, each of those is reinforcing the other. So first of all, yes, you've seen, China's got $3 trillion of foreign exchange reserves. They have borrowing power. They have their own independent central bank and credit system. They have their own banks. The Chinese economy is now quite delinked from the U.S. economy and the West and the economies of the West, largely since they delinked their exchange rate at the end of 2015. That gave them independence in monetary policy. So they don't have zero interest rates. They have room for rates to fall, and they are accustomed to coordinating fiscal and monetary policy. So they have more levers and tools at their disposal at this point to manage adverse economic conditions. You can also see they took very aggressive action, top-down action pertaining to the virus, and controlled the impacts of that. So it's interesting as you look at the Chinese markets this year, they're actually operating very normally because as they had their downturn and their stock market fell, but their bond yields fell, their yield curve steepened, they cut their interest rates, they reduced reserve requirements. It was all like 1992 in the United States or something, right? It was all very normal, and therefore, as a result, the bond returns offset the stock declines, and the economy stabilized, and the stock market didn't fall that much, and it bounced. And so that's operating normally, and then across Asia, you're getting that same effect, because what's happening in Asia is that you shouldn't even think about it as China. You should think about it as an Asia bloc, which is an interconnected set of countries and economies that have a lot of trade, a lot of investment among one another. That's increasingly independent of the West, increasingly inwardly focused, and this had been going on for a few years, was reinforced by policy actions. Then it was reinforced by the trade war and the need out of self-defense, kind of trade internally. And now I think it's going to be reinforced by the virus, by the the society restrictions related to travel and so forth. So so that's just reinforcing the rise of Asia as an economic power. And with that is coming geopolitical power, which has been rivaling the status of the United States as the preeminent global superpower. The United States then kind of starts to react against that. And so that friction between the incumbent power and the rising power is the phrase coined by Graham Allison was Thucydides' trap, which is he wrote a book called Destined for War, which goes back through the last 16 times in history where the incumbent power was threatened by a rising power, and 12 times that led to war. And fortunately, he wrote that book, and China's very aware of that. And the United States is very aware of that. Nonetheless, whether it's military war or technological war or cyber war or whatever, there's definitely a rising conflict. So at the same time as there's a delinking of Asia, of the East and the West, and a greater need for the diversification, and I think of it in terms of maybe perhaps a balancing of a portfolio between East and West. At the same time as the need for that is greater, the threat of it is greater because of the political environment, and even disallowing investments over there and that sort of thing. So, but I would definitely have that I would have Asia as high on the list of investment topics, and I would have geographic diversification high on the list of investment topics. We've gradually shifted more of our activities over in that direction, and we've offered clients ways of doing that. But anyway, that's a big deal.
Bob, those investment topics, I think, lead me into my last question, and then we've got some audience questions as well, and we'll leave some time for the lightning round at the end. Those investment topics, while maybe longer term in nature, are opportunities for investors to build portfolios that can withstand different environments and help them meet their long-term objectives. Do you see any other opportunities right now, given the uncertain and wide range of outcomes you've laid out here?
I think we're going to have to think differently about portfolios, and for example, the 60-40 has the problems that I described. I think that central banks have essentially made the bond yield a funding vehicle. It's not really much of an investment vehicle now, but the abundance of liquidity and sort of the promise of, never-ending zero interest rates is free money, and so they're essentially offering bonds as a funding vehicle. The question is, what do you fund with bonds? What do you fund them with, or what do you buy with the funding? So that's a challenge. But I think it could be an opportunity. In other words, I think that you can flip this around somehow and think in terms of bonds as a funding vehicle. That's something I'd be thinking about against a longer term source of cash flows. Second thing is that probably index investing, I'd be revisiting that, because I think what you're going to have is massive differentiation in companies, in their prospects, and you're going to have some companies that are shorter duration companies that, if this lasts for some period of time, that grinding process is going to take some companies down to zero, and it's going to take other companies, and they're going to be held up by the availability of the liquidity, and probably, maybe even that liquidity gets squeezed in that direction. So that's another thing. Some things we've been working on are, in addition to the differentiation across companies and countries, is looking at stable cash flow types of equities. Like, can you construct an equity portfolio that has some of the characteristics of bonds? Like a reliable long-term return that's not susceptible to economic growth surprises and oil surprises and so forth. And so using the equity market as a way to sort of access the most stable forms of cash flow and spending in the economy is something we've been playing around with. So, but that's just another version of sort of slicing and dicing the equity market, and not thinking of it so much as a total stock market, but recognizing that what are probably going to be significant differences within the equity market in terms of duration, sustainability, survivability, and so forth. And probably that more than growth prospects. It's really balance sheet and survivability.
Great.
And recipients of liquidity that's being produced, and then how do you use that liquidity?
Mm-hmm. Great. Let's turn to several questions we have from clients calling in here. So several about government spending or government stimulation programs. One here is whether you think the Fed will move beyond just treasuries. They've already said that they'd buy corporate credit. This particular person is asking whether they buy equity futures and whether they're doing that already through different vehicles that are maybe under the radar.
No, I don't think they're doing it now. They're basically buying everything but that, though, right?
Yep.
And so it's hey, basically the thing you can count on is that the government will rewrite the rules in order to achieve whatever its objectives are. And so if they get approval from Congress to do that, then they would probably do it if they had to do it. So of course, Japan does that, substantially. So I wouldn't take anything off the table.
And related to that, buying whatever they need to, thoughts on states, municipal finance, the challenges that states will have going forward relative to the federal government.
Yeah, obviously a big challenge. The Fed has some municipal bond support programs out there. Probably, it seems like you could probably count on the Fed a little more than you can count on the federal government at this point, given what some of the things that Trump has said. And so it's I think you got to take a sharp pencil to state finances. Yeah, I agree with that.
Okay. If so, getting more to the fiscal side, if the government does start direct spending, where do you think they should spend it on? Infrastructure? Are there other ideas that you think would get that money into people's hands quickly?
Well, there are a lot of things that they could spend money on that would enhance the productivity of the country. Most of them would be longer term impacts. Let's say, for example, education. If the government spent more money in education, it could that has the biggest long term impacts on productivity economy. There's a lot of, we've all talked about it many times, all kinds of infrastructure programs that could be done. Obviously, clean energy of various sorts. These are all potentially either productivity enhancing or environment enhancing expenditures of money, which would be either good economically or good for society. And when you're funding at a zero interest rate and a negative real yield, it's not very hard to beat that hurdle in terms of doing things that are more productive than the cost of funds. The challenge for the federal government is that our basic government structure is bottom up. It's local, state, federal. When you go to try to put a railroad or a high-speed railroad or a road or whatever in, you got to work your way through every municipality and state, and that's not easy. So the literal implementation of that sort of thing is very difficult. And as an example, the interstate highway system Eisenhower got that done because he claimed national defense. Because at that time, you couldn't transport weapons and so forth or people from one side of the country to the other in an efficient way. So we needed an interstate highway system. So that's how he got it. I got past the rules essentially, right? But it's not easy to do. It's an implementation question,
Yeah, definitely. Do you think the market is properly pricing the risks you're discussing? And what aspect is the market mispricing in particular?
That's so hard to figure because the cash flow and earnings effects are so negative and the liquidity effects are so positive that it's basically impossible to figure out how those net out. Now you sit there and you look at a PE of on trailing earnings of what 18, 19, 20, pick your number for depending what you're looking at. Look at that in relation to history. That doesn't look cheap, right? But on the other hand, the bond yield is even worse. So what's happened is that the production of liquidity has pushed the yields of everything lower, but you still do have a spread against the thing that's even worse than the thing that you might buy. So then it comes down to the duration question, which is how long does this last? How much liquidity can be produced by the central bank and the federal government for how long? Is there enough of that to offset the collapse in income? And what's the and then inside of the various bond and equity markets, kind of player by player, is the money getting to the right places, and are these entities lasting long enough? So it looks like as we do our calculations in the United States, we don't see a great value in the U.S. equity market. We don't see great value in the corporate bond market, but we also, in the corporate bond market, we don't see a lot of downside in the aggregate. Of course, for individual companies, there will be. But mostly because the Fed can more easily hold the credit spreads down than hold the equity market up, because they literally are buying the corporate bonds, but they're not buying the equities. And so for the equities to be held up really depends on the money that they're using to buy bonds ultimately finding its way into the equity market rather than ending up in cash. it's a close call.
Interesting. The next question, I think you might have hit on there, but I'll ask it anyway, just to see if anything different comes to mind. That downward spiral in incomes that you talked about, what are you looking for to, if we do get into that, what would you look for to see a stop to that downward spiral and stimulate an upward spiral? A reference from your prior question, you talked about that spending, the government spending filling that gap of lost income. Anything else there that you'd look for?
Well, the lower you start the unemployment rate in that process, the better your odds are. So let's say we're at 15 now. If we, let's say by the second half of this year, somewhere out there, we go 15, and let's say we snap back to like 8. From 8, as you get to the point that people react and governments say, hey, wait a minute, we just had a strong GDP growth number. GDP was up 5% last quarter. They may cut off the flow of funds. If the unemployment rate is 8, well, then at that point, you're relying on organic growth to bring that down. And you look back at the last 10 years, it took 10 years to go from 10 to 3.5. So, let's say you fall by, you can bring it organically, you bring the unemployment rate down by 0.75% a year organically without a big interest rate cut. So that, and also everybody else in the world is in the same situation. It's not like you can, ride on some other country's coattails. So if you start at 8, after a year you're at 7.25, then you're at 6.5, and then you're at 5.75, and then it's like that's the slope. Now, if you came out of that with an unemployment rate of 5, you're not that far off from where we were, and you can work your way within 24 months or something like that back to, quote, full employment. So I think a lot of it, so the two things I would be looking at would be what unemployment rate are we at when the economy is now on its own and growing organically, and does the fiscal and the monetary, do they index off of the growth rate in the economy or off of the level of economic activity? If they're indexing off the growth rate and they take the foot off the gas, then that leaves you starting at a higher unemployment rate and therefore a longer grind.
Okay, that's really helpful. One last question here before we go to the lightning round. Any comments on gold and its role in a portfolio, especially in this environment?
I think it should have a strong role in a portfolio. What we're talking about is the entire world essentially incentivized to devalue fiat money, to have a monetary restructuring and a credit restructuring. Ultimately, that's probably where we're headed, is some combination of a debt restructuring and a monetary restructuring. The gold is a viable storehold of wealth in relation to fiat money. The thing that I would do, though, is that I would be thinking about gold as a currency, as sort of a contra fiat currency. And I'd be thinking about gold as a currency that I could denominate my assets in that currency. So, for example, instead of, let's say, selling your assets and buying physical gold, what you can do is that you could just buy gold in the forward market, which is essentially like sell dollars and buy gold in the forward market. And that effectively is redenominating your base currency into ounces of gold. It's like holding your assets in denominated in ounces of gold instead of denominated in dollars. And the value of doing that is that you can then continue to earn the risk premium on the assets, but then get the diversification benefits of gold vis-a-vis gold as a currency. So that's definitely something I'd be looking at.
Okay. Great. Well, Bob, let's wrap up with a little fun. So lightning round here at the end.
Okay, well, I'll do my best.
All right. Well, there's no wrong answers, so I'm sure you'll do great.
Yeah.
What is the thing you missed the most while in lockdown?
Thing I missed the most? Can I say two things?
Sure.
People and sports on TV, particularly the Masters, for crying out loud.
So
What happened to the Masters?
that's great. The Masters was Jeffrey Gundlach's answer last week. So that is definitely a theme and one that I would agree with. Great answer. What's been a pleasant surprise while stuck at home?
Well, I've been able to spend time with my kids. I have one child that lives in New York with his spouse, and we quickly grabbed them and said, "You come stay with us." And I have another one that was on the West Coast and said, "Hey, come stay with us." And so we've been able to spend a lot of good time together.
That's
of course,
great.
everybody's working from dawn to dusk. We see each other about 8 o'clock and 9 o'clock at night once everybody's done working, but it's still nice to see each other.
That's great. How about a show, movie, or book you've enjoyed the most during this stretch and would recommend to folks here?
I think, it's probably The Crown is just such a classic, and it's so interesting and it's entertaining, but also you feel like you're actually learning something. Otherwise, I've started to get into some of the Formula One movies and shows. But the nice thing is you don't have to pay too much attention to those. You can just have them on in the background and wait for the race.
Great. All right, two final ones here. The thing that people are not talking about or worried about enough is blank.
Not talking about, well, I think the level, economically, I think it's the level of income and the pervasive and kind of persistent effect of that. I think also the duration of this, that it's likely to last. Let me add two more things. There's the duration, it's the 18 to 24 months, and just sort of saying, okay, let's deal with 18 to 24 months, not 2 weeks or 4 weeks. So what's your personal strategy and what's your business strategy for 18 to 24 months? I would also add one more thing that it's my personal amateur theory, which is that, from a medical standpoint, I wish that the research was more dedicated toward controlling the mortality, the death rate, as opposed to focus on not getting the virus or treatments along the way. But just like if you just take dying off the table, that will totally change the trade-off between economy and virus. And stuff and plus, like from a vaccine standpoint, I'm giving you my own uninformed theories. I'm sorry, but this is the lightning round. To test a vaccine, you're doing that on live people. It takes a long time to do that properly. But how about studying the causes of death of people who died and getting a really tight understanding of the causes of death? And some of the things I've seen are things more related to, blood clotting or whatever that can be dealt with blood thinners. Or, for example, I've seen cases where if you just, gave them high density oxygen that's warmed and highly humidified early in the process, that has an effect. Germany has done a great job of keeping the mortality rate down by what they do is that they first of all, they know if you have the symptom, if you have it, that after they know that in 4 or 5 days is when kind of problems begin. So they come check on you. But if any symptoms start to show up, bam, start to deal with it. So start to deal with it early through basically oxygen and fluids and maybe blood thinners, all the standard stuff that's the basics. And then it empowers your body to deal with it before you get too far down the line. And, it's a rescue operation, So that's what I wish more attention was put on that. If I was president, that's where I would go.
Okay. And our last one, do you have a prediction on a way our world will be permanently changed after this?
I think that we're going to be more frugal. I think we're going to realize we don't need a lot of the things that we thought we needed, that we sort of got addicted to. I think there's going to be a move in that direction, probably for some period of time. It's sort of like, the post-depression
Yep.
generation,
Yeah.
like it changes your consumption, your lifestyle habits. My wife thinks that people aren't going to shake hands anymore, which could reduce the all kinds of passing of flus and colds.
Yeah, definitely. It certainly won't be for a while. Well, Bob, this has been great, super insightful, captivating to hear how you're thinking about things. Really want to thank you for joining us today. I'd appreciate your time.
Good, my pleasure. It was a lot of fun. Thank you, Tim.
Thanks, Bob. And thanks to everyone for hopping on this call to join us. Hope you found it helpful. Hope everyone is staying healthy and safe, and hope you can join us next week at the same time. We'll have Rajiv Jain from GQG Partners to talk about global equities. So thanks, and look forward to speaking with you again. Take care.
Great. Thank you. Bye.